it's not made enough. The markets are blinding us with their ecstasy. See, you had good June numbers from Titan, but they are not giving us the April, May, June numbers. It's quite possible, as yesterday the Technopack gentleman was telling us, that what could not be bought in April and May was being bought in June. And if you looked at the quarter-on-quarter numbers, then they would look pretty terrible. As well, you know, since when have we been expecting that we will hear the last of COVID? I remember in Jan and Feb, Anuj and I would discuss that, you know, it doesn't hit the tropics. This is a China problem. It's a cold country problem. And then we thought a vaccine will definitely come. All the doctors in the world, it's now hit even the US. Definitely, if the best medical talent is looking at it, we're going to get a vaccine soon. You know, the market is living on liquidity and justifying it with hope. So I'm just asking, you know, how do you tackle this? There is a chance of an accident, you would think. Then how should we secure ourselves? Do we diversify? Do we nevertheless go and buy the expensive stocks? How will you tackle the liquidity rally?
Well, Lata, I think as investors, I think it's important for us to kind of be positive and in a way have a more favorable outlook. Yes, of course, the red flags are there, the challenges are there. The speed breakers will continue to be there, and they have been there. COVID or no COVID, you always essentially are going to have bumps along the way. And it's anybody's guess how soon we will basically be able to have a remedy for the COVID virus. But having said that, I think it's more a question of now getting used to it and being able to kind of, in a way, deal with it. And I think progressively, despite the fact that the number of cases have been rising rapidly, but the recovery rate still continues to kind of be healthy. The recovery rate still continues to kind of keep improving. And the fatality rate has been low. It's not kind of that the fatality rate has kind of spiked up. So I think in a way, we all are now beginning to essentially live with COVID and see how we essentially can, in a way, keep continuing to have normalcy and business continuity despite essentially COVID being there. And yes, I think the point is well accepted that it's not going away in a hurry. Having said that, but I think there is essentially the market, there's a broader market, essentially where valuations have come off and prices are a lot more attractive. And the way to really look at this is to essentially acknowledge that, yes, the June quarter is going to be a terrible quarter. April, May, essentially, of course, volumes were low for most of the businesses. June is kind of a bit better, but still not good enough to make up for the hit that businesses have taken in April and May. And the June quarter on the whole will still leave a dent as far as FY21 goes. But I think in a way that as long as we have benign liquidity and as long as valuations remain attractive, one will have to probably overlook how FY21 is going to play out and look for investing opportunities with a perspective beyond FY21. So in a way, we will have to essentially prepare ourselves and look for essentially businesses and how they will play out beyond the current financial year, with an assumption that the second half will essentially be a period of recovery and a period of bounce back, or if I may use the word, a period of resurgence of demand and growth. So that's the way I would really look at it, that yes, the first quarter, the June quarter is going to be bad, the first half is going to be bad, and FY21 essentially is going to be soft versus even FY20. But FY22, I think, could be a lot better as we get back into normalcy, maybe 6 months down the line. So I think that's essentially the way to really look at this market and have a more positive and a favorable outlook from a medium-term perspective.
Okay, fair point. But, you know, Nilesh, while sticking with this quarter itself or the quarter gone by, the quarterly updates so far have not been that bad. You know, whether you look at a Godrej or you look at, I mean, Titan, of course, April was a complete washout. But do you think these couple of companies like Godrej, for example, the resilience that's been shown is more product specific, company specific, or can you take a larger call on the consumption basket, especially where valuations have also fallen now, as some kind of a bet, even if you're looking at, say, the second half of FY21 or FY22?
Yeah, absolutely. I think clearly, Anuj, the consumption basket essentially is going to be relatively more resilient. And I think one will have to also kind of go through the data more carefully, because a lot of companies and in general, what is getting discussed is about the recovery in June. But that's, of course, one will have to see whether we're talking of a month-on-month recovery. Is this basically a Q-on-Q recovery, or is this a Y-on-Y recovery? And I think most of the companies which are still talking about June being better versus April and May. Of course, I think most things would have been better versus April and May. So probably that's really not the way to look at it, and kind of take a view that yes, for the full year, the FMCG companies would essentially have a mid-single-digit kind of a growth as far as this financial year goes. I think in addition to the consumption basket, there are many other sectors which essentially have been relatively resilient. They have gained because essentially the volumes have not fallen off a cliff, or if they have had strong support from expanding margins. A classic case being the cement sector, where of course the volumes have of course fallen, but it's not been as bad, and there's been a huge support in terms of margins. They've been able to have some amount of pricing power, as well as some of the capacities were not fully available. So to that extent, that probably is one sector which actually stands out, where the volumes have not been terribly bad, but and the margins, expanding margins and better pricing have more than taken care of for the fall in margins. So there are such pockets where there's been a lot more resilience. But on the whole, I agree that most of these businesses essentially will have a weak June quarter. But I think post-June, I think one will have to see the kind of recovery that they're able to kind of have in the subsequent 2 to 3 quarters.
Mm-hmm. Nilesh, you are making strong arguments, and it's our job to keep punching holes in them, right? So bear with me for one more round, and I want to talk about financials. You know, I was looking at an India Ratings report. Now, they expect that debt worth almost 1.6 lakh crores is going to turn delinquent over FY21 and 22. This is just the COVID-related issues. Prior to COVID, they were anyway expecting 2.5 lakh crores to go bad. So total cumulative, almost 4 lakh crores of debt to go bad over 21 and 22. And look at the rally. I mean, if I see it from the lows, then Ujjivan, RBL, Equitas, Bandhan, all of these stocks have run up more than 100% from the lows. So what are we missing here?
Well, I'd probably put the two things very separately, that yes, of course, fundamentals are going to be challenged, and clearly banking and financials as a space is probably the worst hit, and it's kind of a perfect beta in terms of the economy. So if the economy does well, the sector does even better. And if the economy doesn't do as well, of course, the sector kind of gets affected even much more than what the economy tells us. And that's a stark reality. And of course, the bad news, if at all, will probably flow out sometime early part of next calendar year, given the kind of moratorium which basically has been extended to borrowers. So to that extent, the bad news is not going to be out probably sometime either before the end of this calendar year or probably the start of the next calendar year. So that's one. Two is, of course, clearly the risk management is going to continue to play. And I think, therefore, as investors, we need to essentially be into the well-managed banks, who of course don't have challenges in terms of a liability franchise, which of course NBFCs have, and so one will have to be very careful as far as NBFCs goes. But I think well-managed banks with strong risk management and with years of experience, I think should be able to kind of stand out way better. In terms of price movements, just let's look at it, that most of these banks or financials had fallen quite a lot, and they have essentially been able to only retrace some of that fall. Maybe the best of banks have probably been able to retrace only 40 to 50% of the fall. And despite this kind of heady move that they have had so far from the lows in March and April, or maybe even the lows between March and May, they still are way lower than the highs that we have seen of them at the start of the year, at the start of 2020. So one will have to be cognizant of that it depends on how you really look at it, whether the glass is half full or half empty. So if you essentially looking at it from the lows, yes, there's been a pretty decent rally. But if you still look at where the highs were 6 months back or 12 months back, they still are kind of far away. And clearly as a sector, it still continues to underperform the frontline indices. So the Nifty probably is still about 10 to 15% away from the highs, but the banking as a space is still probably 20 to 25% away from the highs that they have made. So I clearly think that the markets are telling us that the sector is not out of the woods. It continues to underperform even in a bounce back. And the bad news is going to come out only towards the end of this calendar year or the start of the next calendar year because of the moratorium which has been extended. So I think one will have to be cognizant of that. But I think one should still be very selective and have a couple of strong top quality private banks who've had solid track record in terms of risk management and are going to be able to manage their risk and contain their losses and hits going forward. And I think that's really the way to kind of look at this sector and look at the opportunity.
Okay, actually the market is completely convinced of what you are saying. Nilesh, at the moment, Bank Nifty is going from strength to strength.